Hey guys, welcome to another Trade Genius podcast. I'm my good friend Bob Kudla here. We're going to talk about wage growth and why it's going to be the catalyst that brings this market back down to earth. Let's dive in.
Trade Genius.
So Bob, everybody's kind of wondering what's going on here with the markets, right? Because a lot of volatility, you got a lot of tariff talk. Some people are kind of like afraid, jittery, what's going to happen. But I think when you look at the bigger context of what you're going to show the people here with this chart that you whipped up, I mean, they have a right to be jittery. It's amazing how far over the skis we are now.
Yeah, if you want to know why Trump won the election, throw this chart up, Phil. All right. So when we delinked gold, silver, monetary shackles to the dollar, capital had an advantage in terms of being able to get free printed money at lower than what they should have interest rates. Really what we're seeing here, Phil, is basically financial repression on the borrowing side, where borrowers got access to money that was cheaper than it should have been offered to them. And they'd be able to use that then basically as a club to basically club labor out of existence. And then at the same time, Nixon went to China. So we don't know exactly which one or probably both really tied here, because once we went to China, we basically arbitraged our labor cost away, with the Chinese worker. And I think this all came to a head. It's interesting, Phil. The Sornet wave of the capital looks just like the silver chart of 2010, where you had a high and it sold off, and then you got a secondary high. Now, push this thing forward 2 years, and we're going to see what an Eiffel Tower looks like. And we're probably going to roll that thing all the way back to where you had, back to, I would say, 2016 levels of difference. And at the same time, labor is going to get a stronger protections or security because of the Trump tariffs. So this alligator jaw, I wouldn't even call it an alligator jaw, it's like a broken upper jaw is going to get fixed. And the other thing, too, that people don't realize, the third thing happened here was the baby boom wave going into the job market. Okay. So as the baby boomers die off, they have to sell their stock. And we're joking with somebody. I just got back from Maui yesterday, a little humble brag. And we were talking to the people that were in line with us, and we're both kind of laughing that our kids have no hope of ever buying the house that we live in. In fact, we probably couldn't even buy the house we're living in, today. So you can imagine when we pass on, our property to our children, is that they can't live in these homes, and they're going to sell them, and they're not going to be able to survive without selling the stock that they're going to get from the inheritance, if we even have any by the time we die, right? So you're going to get the situation where as the baby boomers roll off to the back half of their retirement, is that they're going to be consuming stock market value for living expense. And you're going to see that capital area just absolutely collapse. And so that's why when we look at this, environment here, I'm looking out next 15 years, but Trump is the catalyst. And, we're going to get through our March sell-off. We're going to get our April, May pop, and then we're going to get our sell-off into November. And then, Phil, the question that I don't know how to answer yet is that, does Trump try to lift the market into the election, and then the third and fourth year of his term, do we continue selling and kind of almost like an elongated kind of environment? And so that's the only thing I don't know what's going to happen. But I'm just trying to prepare people, the halcyon days of 1996 to 2000 and 2005 to 2008 and the 2010 to 2022, those days are over. And now, if they're going to try to lift it, they can't lift it without massive inflation. And that would be after Trump's out of office. So if the Democrats do take over again in 4 years, then that continues. But if it doesn't, then we're starting to see the collapse of capital versus labor.
Yeah. And the other thing, too, that's going to affect this, or I think where it's going to get a reset essentially, is real estate, right? Because the same thing's happening there, where the cost or affordability of homes is at record levels. It's so expensive right now. And the thing about real estate is it always gravitates back to affordability. What that means for most markets, even the best markets, is you're looking at upwards of a 40 to 50% correction back to that affordability mean, because interest rates, mortgage rates are at 6 to 7%. So you look at where the affordability is back when a lot of these homes were sold, let's say even pre-COVID, if you look at those levels, the same affordability back then. Now, mind you, wage growth hasn't kept up, right? So you have to get back to inflation adjusted price, but then take into account back then with the low interest rates, you might have been at 2, 3, maybe 4%. Now you're going to be more than double that in some cases. Now you're looking at prices that actually means that even inflation adjusted, the affordability is actually less than what those prices used to be. So it means that a lot of these listings are double what people can actually afford. And a lot of that goes back to this labor wage growth and not keeping up. So everything this is a massive bubble with regards to labor growth and how far away we've come from that. I mean, look at the chart there. It doesn't lie. It's just unlike anything we've ever seen. So it's going to be, to me, the scary part is the deleveraging of this, because essentially what we've done is we've kind of created a little Ponzi scheme here of, leverage upon leverage. Where growth comes from is wage growth, job growth, the economy growing, flows back into the stock market and other things. And lately it's just been like a casino with leverage and zero DTE and treasury T-bill pumping. It's not really an organic way to run the market or a sustainable way to run the market. So I kind of agree with you that people are used to like a quick V recovery with the Fed just coming in to save the day. But the difference this time is we got inflation that's not going away. Even, people said, the CPI print beat, but year over year, you're still at 2.6%. That's well above where the box is for 1% to 2%, and that's what the Fed wants to see. It doesn't want to just see a dip into 1% to 2% zone. It wants to see it stay there for a couple quarters, right? And so that's why we have a fight now with the Fed and interest rates. And don't be surprised if they dig in and keep rates paused here for a while. I think the only thing that's going to make them relent, and which usually does, is the job market just tanks. And if we get that, then I think you're going to see a pop. But like a lot of participants think if they resume a cut, the market's going to pump. But I think at that point, it's once again the Fed's late. And then we don't get a pump because now we're in that regime where they're chasing the market down. We're in a recession and bear market. And I think you're going to get like more of an L-shaped recovery this time because of the inflation, because the Fed's not going to be quick to print because they don't have the cover. But if we do get into a point where there's 1, 2, 3 quarters in a row of where core PCE is under 2%, then okay, you could probably get ready for some quantitative easing. The Fed might be getting back to buying treasury bonds, and then you can go higher. But I don't think what we've enjoyed over the last 5 years, 10 years, I don't know that we're going to get back to that as soon as we have in the past, where the Fed comes in and just smashes the print button and bails us out.
Now, when you're taking $1 trillion out of the money supply, and look, we're going to lose 1 million jobs, 500,000 in the federal government, Phil, and 500,000 NGOs, right? All those people, all that money went to pay inflated wages. And look, the people that are going to hurt are all making really high wages. The trough was big and wide here for people, and that money's gone. And so I think Treasury and Fed and Trump are all in simpatico. I think they all agree that this has to happen. This is totally unsustainable, and they rather prick the bubble and try to wrestle it to the ground versus the market picking the time it pricks the bubble, and you get a 1929 to 1932 kind of an unwind. Either we're going to get a 2000 to 2002 kind of unwind, or we're going to get a 29 to 32. I think they're trying to see if they can do the former, not the latter, Phil. So, but tomorrow let's talk about job cuts, because you have a great chart talking about this thing happening, and maybe we can wrestle up some of the stuff that's happened in DC. The unemployment rate in DC and the real estate in DC are telling the story already. And we just lost another, I don't know how many tens of thousands of workers in the Department of Education. So it's just going to start accelerating from here.
Totally agree. Let us know your guys' thoughts in the comments below. I'd love to hear from you. And as always, if you'd like to join us in the trading room, head over to tradegenius.co. Check out our specials over there. A lot of people are having great success, even with the volatility in this market. And you'll be able to hear what Bob and I think from day to day, and also some of the swing trades that we're setting up, take advantage of the volatility. And I think you'll really enjoy that. So thanks, Bob. Thank you guys for watching. We'll see you guys on the next episode. Take care.
Trade Genius.